Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, and back in off the road, the Moose, on May 30th, just after the close. And I'm going to flip it to Moose because really the bond market was where the action was this week. If you recall last week, S&P's a little retrench in the NASDAQ and the S&P down 2%. This week, backing and filling. Clients that I speak to all the time know in this little period, this is just what we needed equity-wise. Again, markets really rebounded well off that March-April drawdown, have gotten a little bit ahead of themselves from a statistical standpoint on weekly momentum. Not anything we worry about longer term, but shorter term, time and price tend to burn off that overbought condition.
Right.
So, tech ripped, consumer non-discretionary ripped, financials ripped, everything traded very well. And they're just retrenching a little bit, spending some time burning off that overbought status. But in terms of bonds, we did have some action. And I'm going to give Moose a pat on the back before I throw it to him, because he has been very consistent for the last 6-8 months talking about a range-bound interest rate market. And let's focus on the 10-year, but you take it wherever you want, Moose. And that range-bound conversation was in the midst of an awful lot of people screaming about higher rates, yelling about lower rates. You have some thoughts and some data on why we're range-bound and where we may break out eventually, but no reason to look beyond our headlights.
Sure thing.
As I like to say. Go ahead.
Sure thing. This week, bonds, pretty good week. 10-year Treasury yield went from a 451 down to a 441 by the end of the day today. Other yields on the Treasury curve also came down. The 30-year bonds down to about a 493. Got out of that 5% territory where it got a lot of headlines. So,
right.
What's important to look at, and you said range bound, we talk about the 10-year. Go back to the day after the election. The 10-year bond was a 445. It went down, it was around that today. It got down lower at 441. That's hardly any change over the 6 months plus since the day after the election.
Right.
That tells you nothing about the volatility.
Right.
And what has driven the volatility? It has been the politics. It has been the tariffs. It has been the Jay Powells. It has been the budget. That's the recent one. Let me show you this chart. We can show it up. We can see here is our budget deficit as a percentage of GDP. You can see that it is now higher than it was even in World War II. That scares the hell out of a lot of people. And that is the tug-of-war that goes on. And the tug-of-war is between that, and the tug-of-war on the other side is between an economy that's slowing, and we see that whether it's pending home sales, which are down 6.3%. That's month over month. Those are big drops. Initial jobless claims higher. Continuing jobless claims higher. I can go on, but the economic numbers are everything that we've talked about, a continuing slowing down. Not diving off a cliff, just going down. And the politics on the other side. But if you think about how we talk about range bound, 425 to a 475 in that range, that's kind of where you're right in the middle of that right now.
Right.
And the idea is that you don't let the politics, which swing you large amounts either way. We've gone down as low as a 385 and we've gone as high as a 480 back before the inauguration. You don't let that throw you off. You let the economics dictate what you want to do. Same thing's true on the municipal bond side, where we have had another drop this week, 3 or 4 ticks down to a 333 on the 10-year AAA. Bond deals well spoken for. Next week we have a lot of supply, 20 billion, but it's a big month for what we call rollover. What is rollover? It's maturing bonds, it's called bonds, it's the coupon payments. Most bonds out there pay 6.1 and 12.1 or 1.1 and 7.1.
Right.
And so, this is a big period. So there's plenty of money to soak up these deals. So it should be a pretty vibrant market next week. But even there, the muni market has also been maybe not quite as range bound as treasuries because it was buffeted by tax talks,
Right.
and of course it was buffeted by the treasury volatility in there. But when you get away from the politics, you try to concentrate on the economics.
Yeah, well said. And in terms of the swings in the bond yields and in the equity market, go back to last week's video, and Moose, what I was discussing is the swings in behavioral emotions.
Unbelievable.
And it tracks so closely with the markets, but in a way that is unhealthy for the investor often. And some of those investors and traders that in the February and March time were thrown off of their longer term objectives and plans are scrambling a little bit now. And that's why you saw this big move. You saw a big move of underinvested money. And you could argue that to some extent having 3 or 4 or 5% cash like we did during that time was underinvested. We played this, as I said 2 weeks ago, very nicely. But in terms of controlling your behavior, your emotions, that's the sign of a successful long-term investor.
Couldn't agree more. And the analogy I would give you on the bond side, if you were looking at the volatility of the treasuries, what you wanted to come back to was looking at kind of that midpoint, where that 10-year bond yield was and where it was versus inflation, which has been dropping steadily by month. PCE this week came in low, 0.1, 2.1 year over year. Fed's getting what they want. Doesn't mean they give you the rate cuts. Right. They're getting the inflation direction that they want.
Right. And one thing I want to discuss in the next few weeks is this stall in rates and cost of money at the levels we're seeing. If we go back to the early 90s, and that was really the inauguration of private equity, very small, grew, and equity markets. This long-term bullish event in equity has been on the back of a 10-year treasury going from about 8% in the early 90s to 0 at one point.
Right.
Back up to that midpoint. That may be a scenario where throughout 25 we have some of that volatility and grind that we've been talking about. The markets are slowly getting used to these higher rates. Money's not free to gas equities. Maybe just be a little bit of a slower patch month to month, quarter to quarter, but join us every Friday. We'll work with you. We'll get you through the highs, we'll get you through the lows, and we'll find some interesting levels to get involved at. Enjoy the weekend.